All right, everyone, welcome. So today we're going to get into a topic that I promise you'll see pop up everywhere once you know what to look for, from the front page of the Wall Street Journal to, of course, your upper-level finance classes. We're talking about treasury shares. And look, this isn't just about memorizing definitions for the next exam. No. This is about building a real foundational skill set. It's about learning to think critically like the financial analysts, the managers, and yes, the entrepreneurs you're all working to become. So here's our roadmap for today. We're going to start with the absolute basics, just building a really solid foundation of what these things even are. Then we'll step inside the boardroom, and really explore the strategic why. Why do companies do this? From there, we'll roll up our sleeves and get into the accounting mechanics, the debits and credits. And finally, and this is the important part, we'll put on our analyst hats to really dissect the decision-making process and, critically, learn how to avoid some very common traps. Okay, let's kick things off with Section 1. Look, before we can even begin to talk about the complex strategies and the financial analysis, we have to be on the same page. We need a crystal clear shared understanding of what we're actually talking about. So let's build that foundation right now. So let's be really precise with our language here. When a company decides to go public, or maybe it wants to raise some more capital later on, it issues shares of stock to investors, right? And once those shares are out there in the world, held by investors, we call them outstanding. Now, treasury shares are not some new kind of stock. They are simply those very same shares that were previously issued and outstanding that the company itself has decided to go out and buy back from the open market. It's literally the company buying back a piece of itself. Now, here's where things get really interesting from an accounting and a legal perspective. As soon as a company repurchases its own shares, those shares kind of enter this state of suspended animation. They're no longer in the hands of the public, so they lose their voice, they lose their power. I mean, think about it. It would be absurd for a company to vote in its own corporate elections, right? Or to pay a dividend to itself. It just doesn't make any sense. So those fundamental rights of being a shareholder, the right to vote on company matters and the right to receive a piece of the profits through dividends, they get switched off for as long as the company holds them as treasury shares. Okay, so now that we have a firm grip on what treasury shares are, we can move to the much more interesting question, why? Why on earth would a company take its hard-earned cash, money it could use for 1,000 other things, and spend it on buying back stock it already sold to the public? This is where we pivot from pure accounting rules into the fascinating world of corporate strategy. Generally, it boils down to two major motivations. The first one is pure mathematics. It's all about boosting a key metric that Wall Street watches like a hawk, earnings per share, or EPS. Now, EPS is simply the company's total profit divided by the number of shares outstanding. So if you shrink the denominator, the number of shares, voila, your EPS goes up, even if your actual profits haven't grown one bit. The second motivation is all about psychology and signaling. When a company's own management team, the insiders who know the business better than anyone, decides to buy back stock, they're sending a very loud, very powerful message to the market. They're effectively shouting, "We think our stock is a bargain at this price." So let's play this out. Put yourself in the shoes of the CEO of our case study company, Future Forward Tech. You're on a conference call with analysts. You announce a big share buyback program. You're going to get asked why. A strong CEO would say something just like this. Look, we've reviewed all of our investment opportunities, and we believe our own stock is the absolute best investment we can make right now. Buying it back is a direct signal of our unwavering confidence in Future Forward Tech's long-term value. I mean, that is a statement designed to make investors feel very, very good. All right, we've covered the what and the why. Now it's time to get our hands dirty with the accounting nuts and bolts. We need to understand precisely how this transaction gets recorded. How does it physically change the look of a company's balance sheet? This is crucial. And this leads us to what is probably the most common point of confusion for students. I see it every single semester. It's a perfectly logical question, right? From day one of Accounting 101, we learn a company spends cash to get something of value. Well, that something is an asset. So if a company spends cash to buy its own stock, shouldn't that stock be an asset? Let's unpack this, because the answer is a firm no, and the reason why is fundamental. The fundamental reason treasury stock isn't an asset is because a company cannot own itself. Think about it. An asset is supposed to give you a future economic benefit. A building provides shelter, a machine produces goods, but a company's own stock? That represents a claim on the company's assets and earnings. You can't have a claim on yourself. So when the company buys it back, it's not gaining an asset. It's effectively canceling out an ownership claim. It's a return of capital to shareholders, and so we account for it in a very special way. as a contra equity account. Just think of contra as meaning against or opposite. It's a negative account that directly reduces the total value of stockholders' equity. Okay, let's make this real with our future forward tech example. Take a look at the before column. The company has a solid equity base, $500,000 in common stock, $300,000 in retained earnings, adding up to a total of $800,000 in equity. Now, they go out and spend $50,000 of their cash to repurchase shares. Look what happens in the after column. Notice, common stock doesn't change. Retained earnings doesn't change. Instead, a new line item appears, less treasury stock, and it's a negative $50,000. That's our contra equity account at work. It's subtracted from the other equity accounts, and as a result, the total stockholders' equity drops to $750,000. The company has literally shrunk its equity base. Fantastic! We've conquered the accounting. We know how to record the transaction. Now we get to do the fun part. We get to elevate our thinking. We move beyond just recording what happened and start to analyze why it happened and whether it was a good idea. This is the leap from being a bookkeeper to being a strategic decision maker. So let's look at the immediate, very visible effect of Future Forward's decision. Let's say before the buyback, the company had earnings of $200,000 and 100,000 shares outstanding. You do the math, 200,000 divided by 100,000, that's an EPS of $2 per share. Pretty straightforward. But after they spend that $50,000 to buy back shares, they have fewer shares outstanding, say about 91,000. Well, their earnings are still $200,000, but now you're dividing by a smaller number. The EPS jumps to $2.20. That's a 10% increase in EPS overnight without selling a single extra product. For an investor just screening stocks on a computer, that looks fantastic. And this brings us to the multi-million-dollar question. This is where your value as an analyst comes in. Is the company actually performing better, or has it just played a math trick? This is a classic example of what we call financial engineering. The underlying business, the actual operations, they haven't changed at all. They haven't become more efficient, they haven't launched a blockbuster product. All they've done is slice the exact same pie of earnings into fewer, slightly larger pieces. Your job, your absolute duty as a financial professional, is to look past that shiny new EPS number and ask the hard questions. Is this real, sustainable growth, or is it just a financial illusion? Okay, to bring this all home, let's finish up by talking about the common mistakes, the analytical traps, that so many students and even some professional analysts fall into when a company announces a share repurchase. Seriously, think of this as your field guide to not getting fooled. First, and most importantly, you have to dig into the reason. You have to ask, is management buying back stock because they are genuinely bullish on the future? Or is it because they've looked around and they have no better ideas, no promising R&D projects, no smart acquisitions to make? A buyback can be a sign of strength, but it can just as easily be a sign of creative stagnation. Second, as we just discussed, never ever automatically equate a higher EPS with better performance. It's a classic case of correlation, not causation. Third, you must always consider the opportunity cost. That $50,000 Future Forward spent, what else could they have done with it? Invested in a new factory? Hired more engineers? Paid down high-interest debt? Was the buyback truly the highest and best use of that capital? And finally, don't forget the balance sheet impact. The company is smaller from an equity perspective. That's their safety cushion. A smaller cushion means more financial risk if times get tough. So, I'm going to leave you with this one final thought. A question that doesn't have an easy answer. A buyback signals confidence. Or does it signal a lack of new ideas? This is the exact dilemma that lands on the desks of CEOs and boards of directors every single day. And as you move forward in your careers as managers, as analysts, as investors, this is the kind of ambiguity you will have to navigate. The numbers will only ever tell you part of the story. Your real job will be to dig deeper, to understand the context, to weigh the trade-offs, and to make those tough, informed calls. And honestly, that is what separates a good analyst from a truly great one.